Hi, how's progress? We've covered a lot so far, including an introduction to debt and some background on its relative level of risk as a funding source. Then we went on to explore the different types of credit, types of interest, and important loan characteristics that can be customized to create what we call a credit structure. In the next section, we'll look at some of the career opportunities available to people that are interested in credit, before diving into the process behind how a lender books new business. Lastly, we'll look at the 5 C's of credit framework and how it informs our analysis of a borrower. Let's get back into it.
If you've made it this far in the course, it's probably safe to assume you're interested in credit. You may even be interested in pursuing a career as a commercial credit professional. But that's a broad term, which begs important questions like, where do credit professionals work? And what are some specific roles that might be a good fit for me? Many credit professionals work for financial institutions, in particular banks and credit unions, where there are lots of rewarding and high-profile career opportunities. Positions at these firms include relationship management, analyst, and adjudication roles. Usually they're classified as either business banking, commercial banking, or corporate banking, depending on the size of the firm and the credit portfolio. For those interested in understanding the landscape, as well as a more complete list of career opportunities in banking, we recommend CFI's Careers in Commercial Banking course. Private, non-bank lenders are another big category of employer for credit experts. Firms include real estate lenders, equipment finance companies, and asset-based lenders. Private lenders target a similar market as banks and credit unions, but may also service riskier borrowers and therefore charge slightly higher rates. As we discussed earlier, corporations also employ teams of analysts to assess credit risk in their own customer portfolios. While the professional context is a little different, these individuals actually use many of the same skills as an analyst at a commercial bank. Another big category of high-performing credit professionals is the rating agencies, like Fitch and Moody's, among others. These analysts assess the credit risk of publicly traded companies in order to help price fixed income securities, like corporate bonds. These folks play a very important role in the smooth functioning of the capital markets as we know them. And finally, many institutional investors also hire experienced credit analysts to manage risks in their investment portfolios and to analyze bonds and other credit-based securities. While this is not an exhaustive list, it should give you a sense of the vast number of career opportunities available out there for well-trained, high-performing credit professionals. There's a fairly predictable process through which credit gets extended to a borrower. We'll use a bank for illustration. First, a representative from the bank will originate new business. This could be through cold calling, a referral, or one of many other strategies used to source deals. Once they've identified an opportunity, they go through a client discovery process where they seek to understand the business, its financial results, and the prospect's borrowing need or needs. At this stage, a good deal of early negotiations will begin around things like credit structure, including the loan features we covered earlier, as well as pricing and fees. Once you have the client's commitment to move forward with your firm, the actual analysis and underwriting begins, often called due diligence. This stage includes the credit application and formal approval from your firm's risk management or adjudication group. They're sometimes also called a credit committee. After an approval is secured, the parties move into the documentation stage, which includes perfecting security. This is where all the loan and collateral agreements are produced, reviewed, and executed with the support of both parties' legal counsels. And finally, the proceeds are advanced, and the loan hits the books of the financial institution. For credit professionals in a more analytical or transactional role, like analysts and risk managers, the process is sequential like this, and they move on to the next deal. For those in a relationship management role, however, you might visualize this process as more of a cycle. See, once credit is advanced, they're also responsible for managing the relationship, which, if done well, should result in originating more opportunities to begin the cycle again, either additional borrowing for the same company or through referrals to other business clients and other lending opportunities. The 5 C's is a foundational framework used by lenders when analyzing and assessing the creditworthiness of a borrower. The 5 C's stand for character, capacity, capital, collateral, and conditions. Character is a lens through which analysts try to understand what the business is all about. Basically, what's the character of the company? Considerations like competitive positioning and strategic advantages, as well as what is the business, and perhaps more importantly, its management team and ownership's reputation within the business community. Analysts may use past repayment history as a proxy for strong character, as well as cues like leadership in corporate social responsibility initiatives. Management's history of successfully operating and growing companies fits here as well. Capacity speaks to the borrower's actual capacity to service debt obligations, including considerations around profit margins, liquidity, and whether cash flows can support principal plus interest payments into the future. Capital is a lens to evaluate the company's financial structure, often referred to as its capital structure. Capital structure is about understanding the proportion of debt versus equity financing. A big part of the capital analysis also includes the business or its ownership's access to other sources of capital, like related party loans, shareholder cash injections, or the ability to raise new equity from outside investors. Questions around collateral include what types of underlying assets are being financed, and are there other assets potentially available too? Where are they physically located? How easily could a lender seize and sell these assets to another party if required? And finally, conditions. This lens is used to evaluate credit requests within the broader context of what's happening in the industry in which the business operates, as well as the broader macroeconomic environment, things like inflation, consumer spending, interest rates, foreign exchange rates, and so on. When it comes to analyzing and underwriting a loan request for a commercial borrower, having the right balance of the 5 C characteristics is very important, but there's no one-size-fits-all. For example, you may get a borrowing request from a firm that has a very weak collateral position, but perhaps they have terrific margins and cash flow, capacity, and maybe management has 15 years of industry experience and a strong reputation for timely payments, character. When taken collectively, these strengths in 2 categories could offset the weakness in collateral and still make good business sense as a loan candidate. Another example, consider a credit request from a family-owned business in a very challenging industry, like print media, let's say. It's very much a declining industry. Conditions. However, perhaps the collateral security available is rock solid, and let's assume this family has lots of other business interests and significant cash available to inject into the company should it be required. In this example, strength in the collateral and capital C's might be sufficient to offset weakness in conditions. As a commercial lender, our borrower is a company, and part of quantifying credit risk is understanding that business really well. In order to do so, at the company level, we would seek to understand, among other things, its competitive position and its management capabilities, and we would conduct extensive financial analysis too, including understanding the amount of, the nature of, and the availability of any collateral security within the context of the borrowing request. But as we know, companies operate within an industry, all of which exist in the broader economy, or the external business environment. Are you beginning to see how the 5 C's fit? They all start to come together here as we look to paint a very comprehensive picture of a borrower's credit risk profile. In CFI's CBCA curriculum, we work through all the individual elements of this entire framework before tying them together in an example loan pricing model, where learners can really start to understand how these factors converge into a measurement of actual default risk and loan pricing. For this course, though, Let's bring these frameworks to life at a high level by touching on some tools and resources, as well as some key financial ratios used in the credit analysis process.